Okay, let's talk about a concept that you might be familiar with, beta. Beta is a relative measure of volatility of a stock compared to its benchmark or its index. In this course, we always use the S&P 500 as the benchmark, and any stock against the S&P 500 that's in the S&P 500 can have a beta that would tell you whether it's going to move more or less than the index. So, for example, if the index is always a beta of 1.0. If a stock has a beta of 1.0, it means that the index moves up 10%, the stock moves up 10%. Index moves up 12%, stock moves up 12%. It moves exactly in tandem if the beta is 1.0. But if the beta is 2.0, it moves twice as much as the index. So if the index moves up 10%, the stock moves up 20%. And if the stock goes down or the market goes down 10%, then the market or the stock with a beta of 2.0 drops 20%. So beta is a relative measure of volatility against the market. Obviously, you would want to know this. If you held a portfolio of very high beta stocks and you thought the market was going down, you would probably want to lighten that portfolio. If you think the market's going up, you would lean towards high beta stocks. So let's look at some definitions. The market portfolio is the portfolio of all assets in the economy. In practice, we use the broad stock market index, such as the S&P 500, to represent the market. That's our proxy for the market. Beta is the sensitivity of the stock's return given the market portfolio, so it's relative to the market portfolio. It's not relative to an absolute number. It's how much it's going to move relative to the S&P 500. If the S&P 500 moves up 10 and it's a beta of 1.0, the stock should move up 10. Let's look at the determinants of beta. There's three listed here. The first one is the cyclicality of revenues. The greater the variability of the revenues, the greater the beta. So if your revenues are moving quite a lot, then you're going to have a stock price that moves quite a lot. That makes sense to most people. And the more movement, the more it's going to have a higher beta relative to the index. Operating leverage. Higher operating leverage means more volatility in the cash flows. If we have more volatility in the cash flows, we're going to have a higher volatility in the stock price, which means, of course, a higher beta. And financial leverage, I've beat this over your head hopefully a lot. The debt equals leverage, so we're talking about high amounts of debt here. And of course, high amounts of debt equal more movement in the stock price, which also equals higher beta. So those are three factors that would impact beta in a company and why it would move different than the overall market. The other thing is we can characterize beta with a regression equation. So you see the regression equation here, and the slope of the line is the actual beta. So for every unit of, and you look at the axes here, for every unit of run on the return on the market is the horizontal axis. For every unit of return on the risk, return on the market, securities, which is the vertical axis, will either move up or down. And so you can see that the line will give you your rise over run or your return on the market. So what you want to think about with regard to beta is if your market goes up 10%, the stock goes up 10%, that's a beta of 1, so you have a perfectly 45-degree line there. And of course, it could be steeper than that or it could be less than that, depending on the individual stock. Now, I'm going to show you how to calculate this. This is very easy to calculate on a spreadsheet, and I'll do that in a separate video, so you don't have to worry too much about the calculation of this. And of course, it's really easy to do a regression equation on Excel. So all you really have to do is set it up right, and it does all the math for you. It's a piece of cake. So I will do that on a separate video. However, we should think about what the formula actually is. So we look for the formula beta, which is the covariance of the security, the return on I, versus or related to the return on the market. Covariance of R sub I and R sub M, and then that's divided by the variance of the market, which is the variance of the overall market, which is sigma squared there, which equals beta, and that's beta for the security I, which could be Google, it could be whatever, Apple, the rest of them. So clearly, there's a couple of things, caveats here. Clearly, your estimate of beta will depend on your choice of proxy for the market portfolio. So in our case, we're going to use the S&P 500. That's a very standard choice of your market portfolio. However, you could look at other things. If you are a biotech investor and you invested in biotech companies, you could look for a relative beta to just biotechs and find a calculation there. And there's lots of other variances to that. There's one other introduction, or interesting thing to think about with regard to beta is how long do you look at the stock prices? So, for example, if you're doing a covariance, the covariance, it can be very correlated for 5 years, and then it could go completely off for 5 years. And so what time frame you look at will change the description of beta. So if it's a rolling 5 years, it'll change over time. Most companies use 5 years or something close to that. Maybe even a closer beta of 3 years would be more appropriate. And of course, we have big events that impact beta, right? So we have a big crash in the stock market and stuff. That's going to impact your beta calculations as well. So it's not an exact science. What beta really tries to tell you is this going to move more or less than the market? It's not going to tell you exactly right. As you can see from the slide that was above here, the regression line is going to not exactly fit the beta equation. There's going to be points above it and below it, so it's not perfectly a perfect line of fit. But it will tell you whether the stock should move more or less than the market, which will give you various degrees of safety. And this doesn't have to be just the market. This can be applied to other things such as projects within a company, which we'll get to in a minute.